Let's talk about the 3.22 Iraqi Dinar rumor, because this number keeps circulating online, and most of the people sharing it don't fully understand what it means, where it comes from, or why the math behind it is more complicated than it looks. Today we're going to break it down properly. No hype, no fake promises, just a clear, honest look at exchange rate policy, what reinstatement actually means, and what realistic currency reform looks like for Iraq in the real world. To understand any of this, you first need to understand how the Iraqi dinar is currently managed. The exchange rate is overseen by the Central Bank of Iraq, which controls monetary policy, manages inflation, stabilizes the currency, and supports the broader financial framework of the country. The central bank does not simply choose a new exchange rate overnight. Every decision is weighed against foreign reserves, inflation trends, trade balance, economic growth, and financial stability. Right now, the dinar operates under a managed exchange rate system, meaning the central bank sets an official rate and steps in when needed to keep things stable. In recent years, that rate has sat at roughly 1,300 dinars per US dollar, with small adjustments made in response to inflation and foreign currency demand. Now let's get into the number that everyone keeps bringing up. The idea that the dinar should reach par with the dollar, a one-to-one exchange rate, is one of the most repeated claims in dinar communities. And while it sounds simple, achieving currency parity is never just a political decision. Exchange rates are driven by productivity, economic size, export strength, monetary policy credibility, and how much confidence international markets have in a country's financial institutions. For Iraq, the long-term goal of a stronger currency is real, and it is connected to genuine economic reform. The country has been working to diversify beyond oil, expand digital banking, modernize financial regulation, and grow private sector participation. The IMF and World Bank have both emphasized that structural reform is essential for currency stability. But when people talk about par with the dollar, they are describing a theoretical future scenario, one where Iraq's economic output and fiscal discipline have reached a level that would actually support that value. And getting there, if it happens at all, would be a gradual process, not a single dramatic announcement. The statement also introduces a distinction that gets a lot of attention online: the difference between a reinstatement and a revaluation. Let's be precise about what these words mean. A revaluation, in standard economic terms, is an official upward adjustment in the value of a currency within a fixed or managed exchange rate system. It typically happens when a currency has become undervalued relative to the economic fundamentals that should be driving it. That is a recognized, legitimate monetary policy tool. A reinstatement, on the other hand, is not a term used by economists or international financial institutions in any formal sense. In dinar discussions, it refers to the idea of restoring a previous historical exchange rate, specifically the rates that existed before the Gulf War, the sanctions era, and the 2003 invasion, when the dinar traded at values close to or above $1. The argument is that Iraq should go back to that number before allowing the currency to move further. It sounds logical on the surface, but the economics underneath it are far more complicated. Here is the core problem with the reinstatement argument. Those historical exchange rates existed under completely different economic conditions, different monetary structures, different levels of money supply, different global relationships, and different institutional frameworks. Comparing the 1980s dinar to the modern dinar without accounting for everything that happened in between is like comparing two entirely different currencies that happen to share a name. One of the most important factors is money supply. Over the past 2 decades, Iraq significantly expanded the amount of dinars in circulation. That happened because the country needed to finance reconstruction, stabilize its financial system after years of conflict, and fund government operations during a period of massive institutional rebuilding. When the supply of a currency increases substantially, its value relative to other currencies typically falls unless the economy grows at a proportional rate. Iraq's economy did grow, but not at a pace that would offset the scale of monetary expansion. That means restoring a previous nominal exchange rate without addressing those supply dynamics would be extraordinarily complex from a policy standpoint, and potentially destabilizing if done incorrectly. The specific number that circulates most often is 3.22 per dinar. This figure is frequently cited as a historical reference point, tied to older exchange levels from before the modern monetary era in Iraq. It is important to be direct about this. No official announcement from the Iraqi government, the Central Bank of Iraq, or any international institution has confirmed any plan to restore that rate. Central banks around the world actively avoid large, sudden currency adjustments precisely because the consequences are severe. A dramatic overnight revaluation could destabilize markets, disrupt trade relationships, trigger inflationary shocks, and create chaos in the banking system. The way serious currency reform actually works is through multiple carefully sequenced stages: strengthening foreign reserves, improving banking transparency, growing non-oil exports, modernizing payment infrastructure, and expanding international investment flows. Each of those steps builds the foundation for the next. Foreign exchange reserves are one of the most concrete indicators worth watching. Iraq has accumulated significant reserves in recent years, primarily from oil revenues. Strong reserves allow the central bank to defend the exchange rate during periods of volatility and signal to international investors that the country can meet its obligations. But reserves alone do not determine currency value. Sustainable strength requires diversified economic activity, productive industries, and consistent fiscal discipline, and those take time to build. Iraq has also been making real progress on financial modernization. Investment in digital banking platforms, payment systems, and anti-money laundering compliance is ongoing. These efforts are designed to bring Iraq's banking system in line with international standards, which matters enormously for global integration and investor confidence. From a short-term perspective, the dinar's value will continue to be shaped primarily by central bank policy, inflation control, and oil revenue stability. Iraq's economy remains heavily dependent on oil exports, which means global energy prices have a direct impact on government revenue and currency management. Short-term changes are therefore likely to remain incremental. The central bank prioritizes stability and predictability. That is not timidity, it is responsible monetary policy. In the medium term, structural reforms could gradually strengthen Iraq's economic position. Infrastructure development, energy sector modernization, and private sector growth may improve productivity and attract foreign investment. Over time, stronger fundamentals create the conditions for a more stable and potentially stronger currency. In the long term, the dinar's trajectory will depend entirely on the overall direction of the Iraqi economy. If diversification succeeds, if foreign investment increases, and if financial institutions continue to improve, the dinar could benefit from stronger global confidence. But appreciation, when it comes, will be gradual and tied to measurable progress, not a single policy announcement. One concept worth understanding for context is the floating exchange rate. In a floating system, currency value is determined by supply and demand in international markets, rather than by a government-set rate. Many countries operate managed float systems, where market forces play the primary role, but the central bank intervenes when necessary to prevent extreme volatility. If Iraq were to move toward a more flexible exchange rate system at some point in the future, market dynamics would have more influence over the dinar's value. But that kind of transition is managed carefully and slowly, precisely because getting it wrong creates financial instability that is very hard to reverse. So what should you actually be watching? Not online forums predicting specific dates and numbers. The real indicators are economic diversification, improvements in banking transparency, anti-corruption enforcement, foreign investment levels, and fiscal stability. These are the factors that international markets actually use to evaluate a currency. It is also worth remembering that a strong currency is not automatically better for everyone. If a currency rises too quickly, it can make exports less competitive and slow economic growth. Central banks look for balance, a rate that supports domestic stability while keeping trade relationships healthy. For Iraq, building long-term institutional resilience is more important than hitting any specific exchange rate target in the short term. The bottom line is this: currency reform in Iraq is a real, ongoing process. Progress is being made in digital banking, regulatory modernization, and investment infrastructure. But that reform operates within the constraints of global markets and economic fundamentals, not outside them. The $3.22 figure is a historical reference point, not a confirmed policy target. Anyone presenting it as a guaranteed outcome is either misinformed or selling something. The responsible approach is to stay informed through official sources, the Central Bank of Iraq, the IMF, credible economic analysis, and to understand the difference between what is actually happening and what people online wish would happen. That gap is where most of the confusion lives, and closing it is the only way to make genuinely informed decisions.